Hi friends, good morning. We're good to go. So today we have a fairly different conversation. It's more on the National Economic Survey. So whatever, an attempt is being made to understand the National Economic Survey more from an informed layman's perspective. That's the expectation, or that's the approach what we have taken in for this initiative. So the National Economic Survey is a document which comes one day before the budget, and that's presented by the Economic Advisory Committee team. And every year they come up with one, a status check, and second, a list of ideas which or possible options which could be worked upon. From a structure point of view, there are two volumes in the National Economic Survey comprising of 21 chapters. The first chapter is more about uh, giving a status check on where we are and what we intend to do, and what are the key drivers to ensure that the country as a nation moves towards overall wellness and development. We also would have heard this concept of $5 trillion economy from where we are. So this would give you a high level connect or a high level idea on what the government or what the economic advice. So for India to become a $5 trillion economy in the next 5 years, we need to have a real GDP rate of 8%, which is about 1.5% higher than where we currently are. So that's what is required. And the government, the Economic Advisories Committee has coined a new term called a virtuous cycle of savings, investments, and exports. And they've identified three key drivers for assisting the economy to reach that number of $5 trillion. One is a private investment, second is exports, and third is capital investment. Now, without addressing at issues in isolation, the approach this time has been to address the issues comprehensively. So there has been a shift from the traditional approach where they've said by advocating growth model, which views economy in either virtuous or a vicious cycle and never in the equilibrium. The departure from the phenomenon of solving job creation, demands, exports, and growth as separate problems, looking rather than looking at these as a single macroeconomic problem. So this has been the accomplishment of India over the last 5 years compared to other countries. So one was the global economy grew by 3.6%. The advanced economies, the developed economies grew by 2.1%. The emerging markets grew by 4.6%. The ASEAN countries by 5%. China by 6.9%, and India being the fastest. So this should give you a different perspective as to how we have moved as a nation over the last 5 years, and the numbers definitely look encouraging. So the average inflation was maintained at half. Okay. Compared to the earlier 5 years. This is again from 14 to 19. And the monetary policy's target is to keep the inflation between 2 and 6%. The JAM Trinity, as they call it, the Jandan Aadhaar and mobile, has been a significant has made a significant difference, especially the direct benefit transfer. GST again was one introduction, and the insolvency and bankruptcy code has made a significant. So this slide talks about how China grew. During the phase from 1980 to 2017, where China had one of the most longest durations of sustained economic growth. And what this statistic says is exports, the orange line, the exports have grown. GCF talks about the gross capital formation, which typically talks about investments being made. Let's say we take the agriculture, the irrigation setup, or the canals being set up. So typical gross capital formation talks about investments and the saving rate. So for the economy to grow, if these three levers go, capital formation, exports, and savings, your economy automatically grows. And jobs, the growth in jobs is more a corollary rather than a targeted number two. The second key driver is to specifically focus on showcasing the importance of savings, because India, the taboo of failure for entrepreneurial ventures is still there in the society, where if someone fails in a venture, he or she is viewed as a failure. So savings rate needs to increase to keep the investment rate also high. Job creation. So job creation, again, if you look at the narrative of the National Economic Survey, it says let's not focus specific initiatives on job creation. If we focus on the other problem, job creation is more a symptom than the disease by itself. So the focus seems to be if higher investment rate is going to substitute, the general thought process is higher investment would lead to higher automation, consequently lower jobs. The growth of computers has only led to the creation of more jobs in different sectors. So there would obviously be a reskilling and realignment of the workforce, but that would by no means move people out of labor or out of employment. And the next key driver, as we saw, is exports. So aggressive export strategy, classic example is China. When so to ensure that or to look to derive a strategy for this purpose, they've come up with this three-pronged strategies. First is about to have a clear vision, then a general strategy to achieve the vision, and flexibility to recalibrate. We also have a strategy. The next is the what are the tools we have to achieve the strategy. First is change the modeling approaches. We saw the vicious cycle versus a virtuous cycle. Measurement of new concepts. So job creation and productivity is contributed by younger firms versus old firms. Sustainable development, behavioral insights. So behavioral economics has been given a lot of thrust. Micro data, employing data as public good. So looking at data as a public good, and more like how you look at any of the public infrastructure like roads. So for the first time, they've started to look at data from that perspective, and using technology to expand distribution of welfare schemes to public. The orange, or the saffron as you may call it, speaks about the population the 20 to 59. So for the next 2 decades, we are expected to have a large chunk of our population in the employable age. And 0 to 19, the younger population is gradually receding, and over a period, you would see the elderly population is increasing. Now, this is also consequent to an expectation of higher growth in literacy. So, whenever the literacy rates have been higher, the population growth rates have come down. So, this is a direct correlation. And with increase in disposable incomes, the average life expectancy also increases. So, therefore, there is a direct correlation to increasing in the aged population. So, what is the role of the financial sector to ensure this development reaches? There must be an investment-led growth. So, banks and capital markets have to come up with innovative solutions. Rapid expansion by disrupting the risk of disruption by financial crisis, derail. So, whenever a financial crisis happens, there is a derailment of confidence, consequent to which your savings and investment cycle gets significantly affected. The quantity of credit given by financial institution increases when there is a boom and significantly takes a batter. Classic is a telling blow. Cleanup of NPAs, the IBC framework, again are foundations which would lead to benefits in the longer run, but there is going to be short-term pain. Yes, lower cost of capital, as India's is one of the highest cost of capital across the world. Lower, definitely when you look at the developed economy, you're talking about 2, 3, 4% cost of capital. Here it starts at 8.5, 9%. So the role of startups, again, I'll just pick up the significant numbers. Last year, we have raised about $7.5 billion in investments from startups. The number of VC deals have come down, but the volume in terms of value per deal has increased. And some of the key sectors where the monies have come: retail, food, fintech, enterprise solutions, auto. So if you look at the largest attractor of FDI in this space has been the consumer-driven businesses. Again, if you notice, the red ones are B2B startups and the blue ones are B2C. There is a clear direction that the focus as far as Indian e-com space is concerned, it's more about the B2C space at this point. So these are some of the thoughts as far as the initial ideas which the National Economic Survey has put through, more in terms of the roadmap which the government has to take to move from where we are to where we ought to be.